Mastery comes from doing the same thing over and over again. I have taken hundreds of trades and made thousands of dollars using this simple strategy that I mastered over the years. And in this video today, I'm going to be giving you my 50 pips a day easy Forex strategy that's going to help you become a profitable trader. I will give you a step-by-step guide so you can master this strategy and use it to make thousands of dollars just like the way I made thousands of dollars by this simple trading strategy. We're going to cover 3 examples. One will be that how you can use this strategy to enter into the trade, and 2 of the examples are going to be that when you should avoid trading by applying the same concepts so you can avoid losing and only focus on getting the winning trades. But just before we do that, if you are new to the channel, consider hitting the subscribe button and turn on the notification bell. And all my social media accounts are in the description. You can follow me on my Twitter and also on my Instagram from the link in description. Now let's deep dive into today's video and learn 50 pips a day easy Forex strategy. So there are going to be 4 steps that we are required to follow. The first step is that we are going to be only using a 15-minute time frame. Our goal is to only look for the trade opportunity using this strategy that's going to give us at least 50 pips in the profits. And to do that, we only have to use 15-minute time frame. Second step is on the 15-minute time frame, we have to identify the market direction by identifying highs and lows of the market. I will give you the example. You will learn how we can identify the market direction. Third step will be we will mark key supply and demand zones, which are going to help us identify where we need to enter and from where we need to exit. And last step, we will be using volume indicator. So these are the 4 steps that we are required to follow. So let's start, and we're going to start with the 15-minute time frame on Euro Australian dollar pair. And the very first thing that we're going to do, we will add volume indicator. So that's the chart of Euro Australian dollar on 15 minute. To add volume indicator, simply let's just go to indicators, type volume and select this one from the list. Once you select, it will look like this. We have to change some settings, and to do that, go to the settings of the volume indicator, go to inputs, make sure moving average length is 20, and we're going to change the style because we have to give same color to both the bars, growing and falling bars. You can select any color that you want. Take volume MA and choose area and change the opacity of it. And that's how volume indicator is going to look like on the 15-minute chart with the settings that I just showed you. Now, how do we identify market direction with the help of highs and lows? Whenever market moves, it does not simply just go up or go down. Market always goes up in a pattern. It first goes up, creates a high, then pulls back to make a higher low when it's going up, and then it continues its movement to the upside to create another higher high. And similar, when market is falling, it goes down, creates a low price, then pulls back up to create lower high before it continues its movement to the downside. So for the uptrend, market is always making higher high and higher low. For the downtrend, market is going in the lower low and lower high sequence. That means when market is going up, it's always making higher high and higher low sequence similar to this. This is going to be higher high. This will be our higher low, which gave the support to the market to make a new higher high, which was higher than the previous one. And then when it pulled back, create a higher low again before making a new higher high. Same goes for the sell side. Market moves down, creates a low price, pulls back up to create a lower high, which is higher than the lower low, but lower than the price from where the market started to fall before it continues to move down to create a new lower low. And that's how sellers work. Now, every time you notice a pattern, market is falling down after it creates a higher high, or market is moving up after it creates a lower low. That means majority of the time, there is always going to be a pullback. So we can take advantage of those pullbacks. Sometimes market does move in a ranging direction as well when there is no higher high and higher low, and market simply consolidates. But whenever it ends the range, it does go up or it does go down. Now here in this example, you see market is moving up. We were creating higher high, higher low, then higher high, then higher low, and then market started to go in a range. Now, when market was creating a movement to the upside, you will notice that it is breaking previous resistance or previous higher highs. It broke this higher high when it was creating a new higher high. That's what we call break of market structure. And every single time from where the market is moving to the upside, from where it's getting a support to go to the upside, it's considered our higher low. And once it is creating a higher low, we will be seeing lots of demand zone that's giving power to the market to go to the upside. So that's going to be our major demand zone from where actually the market started to go up in a very strong momentum. Now, how we're going to be using volume indicator and how it's going to help us in our strategy. So when market is moving up, breaking the previous higher high, volume at that time, it needs to be high as well. High means volume bars needs to be higher than the moving average that we set with the 20 length. So if you look here, when market was moving to the upside, look at the volume, it was a lot higher than the moving average. And that's what we need when market is breaking the previous market structure. There are several key points. First is market is moving up. When breaking the previous market structure, volume needs to be very strong. Second, whenever after creating a new higher high in case of the buyer's trend, when market starts to pull back, volume needs to be very low as compared to the volume in the buy movement. And third, there needs to be at least 3 swings towards the demand zone when market will be making a pullback. So how 3 swings are going to work out is that, let's just say that we have this strong higher high area that market just broke to create a new higher high. And from here, market has started to come down. Now, when market is coming down, every swing that's going to happen, we're only going to consider a movement as a swing when it will break a small previous structure. So here so far market broke 2 structures when making a pullback. That means every time when it breaks a structure during the pullback, we're going to consider that a swing. And we have our demand zone right here. So market needs to come to the demand zone in 3 swings. We have first swing, we have second swing, and whenever market is going to make third swing, it should be coming near to the demand zone. And then what we're going to need, we will need a couple of rejections at the demand. So first key point is when market makes a higher high, volume needs to be very high. Market is pulling back. If it's in the buyer's market and pullback is from the sellers, so during the seller's movement, volume needs to be very low. Another key point, market needs to come within 3 swings at least towards our demand zone from where buyers made a strong movement to the up. And at that point, there needs to be a couple of rejections and volume needs to be in control as well. So we have our demand zone and we know from the higher high level, market is pulling back in multiple swings. So where is our first swing? When we broke the first market structure. And our second swing when we broke the next structure. And our third swing is when we broke the recent market structure and we reached the demand zone. And right after that, you will notice the volume. When market is coming down, look at the volume here. Market is coming down, look at the volume here. It's very low as compared to the volume that was in the buyer's movement. And we have our first rejection right here because we reached the demand zone. And right after we reached the demand zone, we have our rejection. Look at the volume. It started to increase. That's what we need because now buyers are taking control in order to go up. We have our first rejection and at the same area, market should come down again for the second rejection because we need at least a couple of rejections at the demand zone after having this type of market structure. So the second time market came down and it came down with less volume. Again, that's a plus point. And right after it started to get rejected, anywhere you place your trade, put your stops below the rejections and your target at the higher high is going to give you at least 50 pips easily on the 15-minute time frame. And not only that, it's going to give you at least 2.5 times reward on the risk that you're taking. So risk to reward ratio is going to be at least 1:2.5 and you're going to be getting at least 50 pips from the trade. So let's see how it performs. Market is going up, market is moving up, and look, how strongly it went up. When it was going up, look at the volume here as well. And it gave us more than 3 rewards from this trade. And also we made 112 pips. Now pips, they depend on the pair that you are trading. But on the 15-minute time frame, your average pips are going to be 50 and your risk is going to be near to 20 pips. So here is the example where you should not be taking the trade. So this is going to be when should you not trade. We have this perfect buyer's market movement, broke the previous higher high. We have our demand zone here. Volume is very good and we have our higher high. So from the higher high, market started to pull back. We are going down. We broke small market structure during the pullback. We have our first swing. So right after we had our first swing, there was a little movement to the upside. Then sellers went down again to make a second swing, broke a small structure as well. After that, buyers went up. They tried to go up, but they could not. Then from here, sellers started to go down again for the third swing. Now, they reached the demand zone. When they reach the demand zone, you will notice one thing that you should be putting your focus on every single time when you're using volume indicator. And that is, look at the volume when market is going down during the pullback. Volume tends to go higher than the moving average, which should not be happening. So when volume is too much high, and also at the same time, look at the strength from the sellers. They are coming down with a lot of strength. They did reach the demand zone here. They did reject here. But after that, when buyers started to go up after the first rejection, there is no volume at all. So we are not going to touch this trade because when market is coming down, there is a high volume. And when there is a rejection and buyers start to go up, there is no volume at all. So look what happened afterwards. Buyers did try to go up, but they're inching their way to the move upside and we never got any second rejection. This could have happened as well that the sellers, they simply just moved down after the struggling buyers movement. However, these type of patterns we should be always avoiding. Another example here is we have this strong sellers movement. We have a high volume when market broke the previous market structure and created a lower low. After that, we started to have a pullback and buyers, they are going up in a very nice struggling way. We have our first move up. We have our second swing as well when we broke the recent structure during the pullback. And right after that, market did went up and we reached near to our supply zone. But we haven't really reached exactly at the supply zone. And sellers, they made a movement to the down. And when they made a movement to the down, the good thing is that we have a strong volume in the sellers movement. And that's what we need. After that, buyers tried to go up again. This is going to be our second rejection. We are not really at our supply zone, but we are near to it. However, we have 3 swings. We have similar volume that's what we need. And after the third swing, sellers, they took control and they came down with a lot of strength and also with a high volume. That was our first rejection. So second rejection is going to be market has to test this area. And when buyers are going to come up, they should come up with low volume. However, they were coming up with low volume, but suddenly they took up some volume, which we can see from here. So when they picked up some volume, we have a lot of volume increasing. And then suddenly we went way higher than our rejection. Not only that, we even are now at the area which is our supply zone. So from that supply zone, look at the strong rejection. When we had this strong rejection, even if you wanted to take the trade, you cannot do that. Let's just say after this strong movement that you saw, you end up chasing the market and you take the trade from here. You put your stops here and you put your target here. Yes, you will be getting more than 50 pips, but look at your risk to reward ratio. We're not going to be doing that type of trading. When your risk to reward ratio is less than 2.5, we are simply not going to touch those trades because we want our setups to give us higher risk to reward ratio and also higher chance of performing in our favor. That type of market structure you should always avoid as well. So we looked at one example of the market structure that we exactly need in order for us to enter into the trades. Then we looked at 2 different market structures we should always try to avoid. That was very simple strategy. We laid down every single step that you need to know in order to master this 50 pips a day trading strategy. Let us know in the comment section what are your thoughts about this strategy and if you got any value out of this video. That is my very first video on this channel. If you can subscribe and share this video with your friends, that would be a great help. So thank you so much guys for watching until the end. This is it from this video. I will see you in the next video. Bye for now.